Welcome to this Killick Explains video, and welcome to my new post-lockdown look, which hopefully won't distract you from what's going on over here. So, topical one this time, volatility. I don't need to remind you this year's been incredibly volatile, and what I'm going to say is that it's here to stay for a while. And I want to look at some of the forces behind that and justify why I think volatility is something that stock market investors in particular will just need to get used to. It's not a problem. It's the price you pay for the sorts of returns that are possible from long-term equity investing, but it's something that you need to just get comfortable with for the time being. So, part one coming up, which suggests there's more than one part to this series. There are in fact three. So, background to this would be what? Well, earlier this year, stock markets dropped hugely, 30 to 35%, and we're talking major stock market indices here around the world, UK, Eurozone, US, and so on. In a few weeks, they recovered equally fast, and that took a lot of people by surprise. The Nasdaq, the tech-heavy US index, actually managed to achieve a new peak soon after the pandemic struck, and a lot of people were surprised by that, quite rightly. So huge volatility, rising volatility has been a theme. So that was the big dip followed by recovery, but ever since then, daily moves, 3, 5, 2%, volatility's here to stay. Now remember, I'm not suggesting that's a big problem. It is the price you pay for the sort of returns you can make from equities, but we need to understand what's going on. Now, the three forces that I think are particularly important, some may disagree with me, are as follows. The actions of central banks and very accommodative monetary policy. And you could add in fiscal policy too, but we'll take a look at that in part one. In part two, I'll deal with the rise of passive products. Now, I'm not saying this is inherently a bad thing, but I am saying it's had an effect on markets. And number three, the behaviour of investors. Now, again, I'm not necessarily saying that the market's gone mad. I'm just saying these three things combined do add up to more volatility, and volatility that's like to stick around. And because I'm doing a précis, as usual in these videos, there's further reading available noted at the bottom there. Okay, so let's take on part one. Parts two and part three in other videos. So, the role of central banks. Well, what have they done? Interest rate cuts to the point where central banks are quite happily contemplating negative interest rates. In parts of the bond market, you have got negative interest rates already, in the Eurozone for example, so effectively you hand over your money and pay someone to keep it. Fairly sort of mad stuff, if you like, combined with market stabilisation. Now, I don't intend to deal with quantitative easing and all its various iterations, if you like, in this video. I do that elsewhere, but put very low interest rates with market stabilisation and whatever it takes levels of market stabilisation, and you give people an incentive to take risk and the confidence to do so. So you unleash those animal forces, if you like, which is ironic, you might say, when you're trying to stabilise markets, but that's a function of what central banks have done, I would argue. Now, chasing returns. So where's the evidence for this then? Well, an investor seeking an expected return of 7.5%, a number I've made up, by the way, it's no promise, guarantee. According to Callan Associates in 1995, they could have done that basically from a portfolio of bonds with a standard deviation, I've got a separate video on that, of 6%. In other words, at a relatively low level of risk, to translate that for people who are wondering what I'm now talking about. Move on to 2005, and to achieve an expected return of 7.5%, that's the target here, you needed more like 50% bonds mixed up with 50% equities, with a standard deviation, introducing some equities into the mix there, and more like 9%. And then roll forward to more like now, sort of autumn 2020, and it would be around 12% bonds with equities comprising the rest. So the bulk of the portfolio would be equities, and now your standard deviation is 17%. So in other words, the important point is that that number has crept up considerably, as has the blend in the portfolio has changed in order to achieve that. All right? So broad-brushed piece of evidence number one, that there is inherently more risk around, if you like. Now, piece of evidence number two, specific behaviours that have changed, if you like. Where are we seeing people loading up on risk in certain parts of the market? And this is just one example. Well, covered option writing. Now, that sounds like a pretty ghastly thing to mention, but I've done a video on it separately. That is essentially a fund manager with a portfolio of stocks happy to just sell options to other people who want to take a bit of risk, want to bet on rising stock prices. And the fund manager basically is committing to take a premium up front from those buyers and deliver the stocks in the portfolio at a pre-agreed strike price in the future. Okay? Now, it's a way to generate yield. Essentially, you get a premium up front if you sell these things as a fund manager, all right, via exploiting the options market. Now, when share prices rise fast, so do option premiums and the need to hedge option exposures. So the point is, you'd think as volatility increases, people might back away from this kind of trade. Dabbling in options sounds like a fairly risky thing to do. They're derivatives, even if you don't fully grasp what these things do, but actually no. What we've seen is in 2010 there were 20 funds with around 20 billion AUM using this kind of mechanism to enhance yield, and now we've got more like 150 with a much bigger asset pool behind them. So in essence, what that tells you is there's demand for options out there, which is what allows these funds to write them, and they're covered because they're written on stocks they already hold, and that's a little bit counterintuitive, you might say, when volatility is rising, because option premiums go with it, it gets more expensive to buy these things, and the risks associated also rise too. So, is this here to stay? Are these short-term factors? No, I don't think so, because central banks are the gift that keeps on giving, and my goodness, this year have they stepped in to prove it. So, the Federal Reserve did as much in a month back in early 2020, quite a stat, as it did in over a year in 2008. So the response to the financial crisis, people thought, oh, crikey, this is central banks doing whatever it takes, jumping in, stabilising the market, cutting rates, quantitative easing. Wonder how much of that we're going to see again. Well, crikey, did we see a big dose of it at the start of this year. And essentially, the top 10 most popular hedge fund strategies now all demand more risk, largely as a result. So hedge funds are ridden on the back of this, and this sets the scene for sharp deleveraging and sudden calls on collateral. And that translates for equity investors as the likelihood of more and sudden and unexpected volatility. So there's evidence, in other words, that investors have changed their behaviour on a platform of central bank action. In other words, they're prepared to take more risk, and they're getting increasingly confident that that's the right thing to do. Okay, so that was part one, dealing with central banks. Part two, for those people following the series, will be on the rise of passive products coming up, and then part three will deal with the behaviour of investors. And just to mention at the bottom again, that paper, for those people who'd like to read about these points in a bit more detail. Otherwise, you can just ping me at the usual place to ask any specific questions on what you've just seen.